Hey guys, welcome back to Father and Son Investing. Today's video is the November 2023 Treasury Note and Treasury Bond update. Now I actually have far more information for you than I could possibly present in a video that you would want to watch in a reasonable amount of time. So I'm just going to try to present what I think is the most important bits of data here. But there's a lot happening with the Treasury Note and Treasury Bond market. Let's just take a quick peek at what happened yesterday. This is courtesy of the Wall Street Journal. They have a nice little summary page for bonds. And looking at it from a 5-day perspective, you're going to notice on each of these that there is this steep decline that occurred yesterday. What happened yesterday? Well, it was the jobs report, and it came in at 150,000 new jobs for the month of October, which was considerably less than expected. They expected 170,000 and way more than what we had for September. Remember, that one was over 300,000. It was actually revised down to 290,000 with this latest report. But each of these, look at them all, 2-year, 5-year, 10-year, all of them declining. Now, the Treasury bills did decline as well, but you won't necessarily see quite the same degree, and that's because Treasury bills kind of play in a different market than Treasury notes and bonds, which is why I keep them separate on these videos. Now, earlier in the week, we had the Federal Open Market Committee meeting that met on October 31st and November 1st. They, of course, gave their recommendation on Wednesday, November 1st, not to increase interest rates. I've read through the minutes for Chairman Powell's press conference. I'm not going to share all of that with you, but there is one important statement in there that I'm going to share with you a little bit later in this video. Of course, that recommendation not to increase interest rates from the FOMC certainly had an effect on the bond market as well, and that is because people start thinking that they've reached a maximum for rates. They're thinking 2 meetings in a row must mean that the Fed is done. Now, I'll tell you that in those meeting minutes, they did not mention that they are done at all. In fact, they're not talking at all about rate cuts at all. Meanwhile, what has been happening at the Treasury Department? This video actually is going to spend the bulk of the time talking about what's going on at the Treasury Department. I'm going to give you some of my opinions about what I think has been happening there as well. There have been a couple of important announcements this week from the Treasury Department. The first one occurred on October 30th, where they announced the marketable borrowing estimates. This announcement essentially just tells us how much the Treasury expects to borrow during the quarter, not necessarily in what way they will borrow it, meaning Treasury bills, notes, or bonds, and how much of each. So they came in and said they expect to borrow $776 billion during the quarter from October to December. They also go ahead and give us an estimate of what they think they're going to be doing during January and March. Of course, this will change during the next announcement, but they're expecting to borrow $816 billion. Then on November 1st, the quarterly refunding statement came out, and this one really talks about more of how they're going to go about borrowing that money. I want to read to you here the first paragraph before I get down to the numbers that shows what's happening with Treasury bills, notes, and bonds. This first paragraph to me is scary. It says the U.S. Department of the Treasury is offering $112 billion of Treasury securities to refund approximately $102.2 billion. That's right, I said refund $102.2 billion. They're going to borrow $112 billion to give back to people that have their notes and bonds coming due, $102.2 billion. You know, if this wasn't the government, we would, I think, be looking at this as a Ponzi scheme. Taking in money to pay back investors. How does that sound? All right, I want to show you the numbers then of what the next refunding statement looks like in terms of notes and bonds. What you're going to notice here is that when it comes to things 7 years and less, the numbers are going to go up. So for November, it's going to be 54 billion worth, and in January, they're planning on selling 60 billion worth. That's up from 45 back in August, and you can kind of see the numbers here. So everything from 2 years to 7 years, the numbers will go up. Looking at the 10-year, 20, and 30-year, you're going to notice that those numbers aren't going up. In fact, they go down. So we're going to see as time goes on, yes, it's 40 billion for the month of November. That does go up, but then it starts to drop. And you're going to see similar. November it goes up, and then it starts to drop. Now, the market got all excited about this when they heard this announcement, because what they heard was 10-year note. That's what a lot of things are based off of, right? That's what mortgages are based off. 10-year note rate or 10-year note issuance going down, and the actual yield came down, the price went up. I want to show you how these recommendations came about. And it's a very interesting thing, and it really hasn't been discussed much in the news. It also occurred on a press release on November 1st from the Treasury. So we're going to move over to that. On November 1st, this was released. It was a letter that was sent to Janet Yellen, the Secretary of the Treasury, on October 31st. And it gave a lot of recommendations in terms of what this entity called the Treasury Borrowing Advisory Committee had to say, what they recommended in terms of the next quarter's allowances for Treasury bills, notes, and bonds. So let's get to this. First of all, you should just know, what is the Treasury Borrowing Committee? This is just taken from the Treasury's website, and it just lets us know who comprises that committee. It says senior representatives from a variety of buy and sell side institutions such as banks, broker-dealers, asset managers, hedge funds, and insurance companies. They present quarterly some recommendations to the Secretary of the Treasury. So now that we know who they are, I'll tell you then that they issued this nice letter to Janet Yellen. And this is actually a very interesting read. It only takes about 10 minutes or less for you to read it. But if you ever want to understand how Treasury bond yields are affected, the number of factors that go into this letter here is very succinct and will give you a fantastic overview of what goes into Treasury bond yields. Now, rather than just read the letter to you, I've gone ahead and just highlighted things in there that I think show what I just talked about, what goes into Treasury bond yields. We're going to just kind of quickly run through these. Then we're going to get to what the Treasury Borrowing Advisory Committee's recommendations were. But before I get to that, I actually want to play you an excerpt from an interview that Bloomberg did with Secretary Yellen just this week. And I want you to hear what she had to say about the reason why she thought that Treasury yields had risen so much recently.
So I want to ask you a little bit about the rise in yields that we've seen. We've seen yields surging over the last few weeks. The 10-year Treasury rose above 5% earlier this week. What's your view on what is driving that surge in yields, and how much of it is connected to investors' concerns about the U.S. deficit?
Well, I don't think much of it is connected to that. This is a global phenomenon. In advanced countries, we're seeing yields go up in most advanced countries of the world. And largely, I think it's a reflection of the resilience that people are seeing in the U.S. economy.
Now, when I heard that on Bloomberg, actually, I was pretty disappointed. Janet Yellen has a long and storied career as an economist, both in the academic world and in the government world. Obviously, she was the chairman of the Fed just before Jay Powell took over. So it disappointed me because I felt like she had suddenly become a politician and was no longer an economist here. In fact, the person on Bloomberg said it sounded like she's not singing from the same hymnal. And so just these two cartoons kind of represent that. If these are all the members of the FOMC, and imagine this person here in the middle is Secretary Yellen, she's not singing from the same hymnal that the FOMC committee members are. She is, however, singing from the same hymnal that the cabinet members sing from, because as this one says, there are no cabinet splits. We're all singing from the same song sheet. That same song sheet, though, may actually be screaming help on it. So I was disappointed. Now let's get to what was in this Treasury Borrow Advising Committee letter that you may not be aware of. So first of all, they gave a number of factors of what they thought could be driving that. I will tell you in the end that they don't say that it was the robustness of the economy. Nevertheless, let's just peek here. They do mention number one, the response to stronger than expected activity in the labor market. That's what Secretary Yellen was talking about. They talk about neutral rate of interest now higher. There's a neutral rate at which inflation balances out with jobs, and that's actually the Fed's job, is to keep inflation down and to keep employment at a maximum, balancing those two factors. So they're saying here there's the possibility now that the neutral rate of interest may now be higher than what it used to be. They went on and talked about supply-demand dynamics, and the return of a positive term premium. Remember, that term premium is what people expect for giving the government money for a longer period of time. In a correctly functioning bond market, a 2-year note should not be paying more yield than a 10-year note because you're giving the government money for longer. They talk about market participants are revising their expectations for near-term growth and revising down the possibility of a near-term recession. They're looking at that soft landing. Market participants seeing a soft landing here. Of course, if a recession isn't coming, then there's no reason why those long-term rates should be dropping. They talk about changing expectations around the near-term monetary policy path. That's what the Fed does. They issue monetary policy. And they talk about that the Fed may have some near-term monetary path changes. Go back to that, the minutes from the Fed Chair Jay Powell's press conference though on Wednesday, and he reiterates. They are not talking about cutting rates at all. They talked about the rise in 10-year yields largely due to higher real yields. If you're not familiar with that term real yield, then just go ahead and take what the yield is that someone's getting, subtract inflation out of that, and that is what the real yield is. So they're saying that real yields have gone up. They use tips as the way to go about figuring that that has happened. Next, they talked about inflation, the two ways it gets measured, both the CPI and the PCE, and that both measures of core inflation had strengthened on a monthly basis in September. We're going to be waiting for October's numbers coming up here. We'll talk about when that's going to happen. But both of those had gone up, and so that certainly could be a reason. They talked about a view among market participants that there's a growing imbalance between supply and demand for U.S. Treasuries. So the supply is going up, the Treasury just keeps issuing more and more debt, but the demand for it seems to be going down, and that creates that sell-off that you've been hearing about. $60 billion is running off each month from the Treasury. Let's take a look at that. What is this talking about? The Treasury's balance sheet. This is what the Federal Reserve's balance sheet runoff looks like this year. This is what they call quantitative tightening. If you want to understand quantitative easing, the exact opposite of this, I'm going to put in the links below a link to a PBS video that they put out earlier this year talking about the effects of easy money. It's about a 2-hour-long video, so I've actually been taking it in segments. I don't have enough attention span to watch a 2-hour-long documentary here, but fascinating and gives you a lot of insight into how the government money situation, both fiscal and monetary, has been running. Okay, let's get back to this. Total assets of the Federal Reserve. Okay, it spiked up here in March. What happened in March? Well, of course, that was when there was that banking crisis. We had a couple of banks failing. The Fed went ahead and repurchased some of this here. Then it's been running off again to the tune of $60 billion a month. This is $60 billion a month in Treasuries. There are other assets that they hold that have also been running off, so we're looking more in the range of about $90 billion a month total. They're not selling, they're just not repurchasing. So when one of these U.S. Treasuries comes mature, be it a note, a bond, or a bill, they just go ahead and receive the money back from the Treasury and they don't repurchase one. The appreciation of the U.S. dollar, of course, the dollar has been going up as yields have been going up, and that forces some foreign banks to consider liquidating their Treasury securities while they try to defend their own currency. Now, there were some investors who had already decided when yields hit 4.25%, hey, this is about as high as it's going to go. Let's just go ahead and push all our cash in here. So they've already used up their money to buy their quota or what they could afford of, say, a 10-year note or a 30-year Treasury. Well, since then, of course, yields have gone up even higher, but these people who all purchased back at 4.25% are now out of the game, which then limits capacity. It kind of limits that liquidity, the ability to purchase the U.S.'s debt. Speaking of that, there are investors who own mortgages. Now, when mortgages were cheaper, of course, people might pay off their mortgage early because they had cash to be able to do that. Well, now more of their cash is being pushed into interest, and their ability to pay off a mortgage early is going to go down Because that money is tied up now in that mortgage, other investors now no longer have the cash to be purchasing U.S. securities. In the end, the committee concluded that the bulk of the long end yield moves were driven by, no, not the economy, as Secretary Yellen said, driven by increased term premium, what investors expect for giving the government their money for longer. Now let's just talk about the conclusions then of this committee. They said effectively, while there is still reasonable demand for U.S. Treasuries from domestic and international market participants, it has not kept pace with the increase in supply. The demand is still there, but there's not enough demand for the supply at the yields that there were. They had to drive up the yields to be able to get people in the game to purchase U.S. Treasuries. They did say this was somewhat offset by strong demand from money market funds as money shifted from the overnight reverse repurchase facility. I just want to show you this quickly. If you watched the T-bill video, you've seen this, but some of you may not be buying T-bills, and so I'm just going to show you quickly what they're talking about. On the bottom line of this graph here, this shows the amount of money kept in the Fed's reverse repo facility. If you're not familiar with the reverse repo facility, just know that the Fed allows banks or other entities to store their money here, and this allows the Fed then to essentially loan their money out to other banks. So they give them an interest rate. It was around 5.1% back in June, and therefore these money market funds were just happy to keep their money there because the Treasury yields had not reached this level yet. Then, of course, in June, when the government decided to kick the can down the road for the debt limit, the Treasury started purchasing Treasury bills, and money started flowing out of this reverse repo facility into the Treasury market. Of course, yields came up, and it was more conducive, or more incentive was there for money market funds to move their money to something that was yielding even higher than 5.1% that the Fed was offering. You can see how the money has just drained out of this facility. It's down now close to $1 trillion, where back here it was up close to 2.5 trillion. So that's what they're talking about when they talk about the Fed's overnight reverse repo facility. All right, if you were paying attention then, you saw then how that blue line has been going down. At some point, that blue line is going to reach a plateau where there's not going to be any more money flowing out of that. If it got too low, the Fed would have to increase the interest rate in order to help keep money in that fund. So at some point, it's going to reach a plateau, and the liquidity there is going to be drying up as the Treasury plans to keep on selling bills. There's going to be less of a market for it, less liquidity to buy it. Their ultimate recommendation was that the Treasury should consider skewing increases in issuance towards tenors which have less sensitivity towards term premium increases, the lower end of the spectrum, and I showed you that in those numbers, from the 7-year notes down to the 2-year notes. That's where they were going to be selling the most, because those have less sensitivity to that term premium increase. Many of you are probably bored to tears. I'm sure I've already lost a considerable number of you. If you've made it this far, then congratulations. And here's what I'll tell you I expect for Treasury notes and bonds. I expect that 10-year Treasury yield is going to be pretty volatile still. In fact, coming up in mid-November, we're going to see on back-to-back days both the CPI, the Consumer Price Index, and the PPI, the Producer Price Index. And if that comes in hot, we're going to see this downward trend reverse. And I think we're going to see that up and down, up and down. I think that the 10-year Treasury is not going to continue to plummet like it did yesterday and earlier this week for the reasons that I've given you in here, having to do with supply and demand. And really, the Treasury just kind of manipulated things for this quarter. I don't know that they can continue to do that. In fact, in that letter, the advisory committee talks about doing what they did this quarter, potentially next quarter, but then after that having to go back to increasing issuance for those higher term notes and bonds, the 10 through 30 year. So the Treasury has kind of manipulated this here in order to keep the yields from going too high, but I see this as being temporary. They've essentially kind of squeezed a balloon, and while they've squeezed the 30-year end of the balloon, of course, it balloons up the Treasury bill end, and that causes its own set of problems when the percentage of Treasury bills gets too high. All right. I hope that you enjoyed this. I hope you got some information you're not getting elsewhere. If you did, please let me know in the comments. And please give us a thumbs up. We need that. We'd love to have you subscribe as well. And as always, until next time, enjoy your investing.